Hello, welcome to episode 5 Early Exit Strategies. So, I apologize for the weird looking screen. I'm just experimenting with virtual backgrounds, and I got a new mic, so hopefully the sound's better. So, most option traders don't hold their options all the way through expiration. They use their gut and some rule set to close out their positions early, before they expire. For example, after they've made 50% of the premium, or after they've lost double of the premium, or when there's 3 days left, or when the annual yield has gone down to like 5%. They'll go ahead and close it out early. Wow, my nose is chopped off. I think I like it. So some examples are they would close it out after they've realized 75% or 50% of the premium, or when there's 2, 3, 4 days left, when the annual yield has gone below some threshold like 10% or 5%, or like in this episode, exit if the option goes above twice the premium collected, or some combination of any of the above and other ones that are not mentioned. So we're going to start scratching the surface of exit strategies in this episode. We're going to use a simple max loss exit strategy. Again, it will exit if the option goes above twice the premium collected, and we'll see how it compares to always running to expiration. And we'll look at during the pandemic when this max loss strategy really did well, and then other scenarios where maybe it won't do so well. We'll find out. If this is your first time here, this channel is about using backtests to find option strategies that have made money in the past and avoiding the bad ones, the losers of the past. I think Mark Twain was given credit for this quote that history doesn't repeat itself, but it rhymes. So this channel is all about trying to find those rhymes in the mountains of option quote data. I'll be running backtests and visualizing the results for you. It's custom Python software. It uses 20 years of daily option quotes to do the back tests, or about 85 gigabytes compressed. This is not trading advice. Do your own research and make your own decisions. If this sounds interesting, please hit the like button and subscribe, and feel free to request a back test or feature. So let's get started. Let's take a look at Disney during the pandemic. This is from the point of view of a put seller. You're looking at every kind of put contract found in the data with a DTE of about 45 days, delta of about minus 0.4 or a 40% chance of getting assigned. It found 91 legs between November 2019 and May of 2020. Each blue leg represents the lifetime of a put option from the sell date until expiration. There is no early exit strategy shown on this graph. Each blue leg has a matching gold leg, like this guy here, that represents what the underlying Disney stock did during the lifetime of the option contract. Notice if the matching gold leg is flat or upsloping, the put made money, usually the full premium, like all of these over here. But if the yellow line has a noticeable downslope, then the put probably loses money, like during the pandemic, right here. So as you can see, during the worst of the pandemic crash, the sum of all these puts fell to almost minus 500, or $50,000. Then they had a nice recovery all the way back to only a minus 120, or losing $12,000. Now imagine if the put seller had some method of keeping their losses smaller and more manageable. Say they would close out or buy to close any position that was losing more than double the premium they collected. That would really help with all those big down legs in January, February, March of the pandemic. Well, here you go. This new chart on the right shows just that. These red legs, where the mouse pointer is, they're all shorter and represent option contracts that have more than doubled and were closed out early.
these really short ones here where most of the gains occurred for this strategy, or the smaller losses, I guess I should say. Instead of moving down to almost minus $500 or $50,000, this strategy reduced the losses and only moved to about minus 130. That's a pretty big improvement over the no expiration strategy. It was then able to take advantage of all the winning puts after the pandemic crash and finish up over $26,000 instead of down $12,000. This is kind of the perfect setup for this strategy. It will rarely crush the no exit strategy like this. In fact, I'm guessing it will probably usually lose to it, but it'll have much smaller downswings.
So here's the opposite scenario when the run till expiration strategy outperformed the max loss strategy. It's Disney after the pandemic all the way through July of 2022. And it's got a lot more legs, 219. So running through expiration, you'll see, made about $24,000, where the max loss strategy lost about $2,000 over here. Why? Look at these early closeouts. Like here and here, see how they lose a lot of money, where that maps to this area right here, where you let it run through expiration, the puts would have recovered from where they were closed out. People were buying the dip. So here I've zoomed in on Disney during that time that I was just highlighting. And so, like, your puts would have been closed out early right here, but then they bounced right back up and you would have earned all the premium if you hadn't have closed out early. And then the same situation happened right here. Well, it looks like it's going to be a little more complicated than just having a simple max loss strategy. We want to optimize our option selling profits without going through crazy variance, and that's going to take a much deeper dive on exit strategies. We're going to have to try out several strategies in different combination over lots of data. So I'll definitely be revisiting this topic in the future. But that's a wrap for this episode. In the future, I'm thinking of doing a series of comparing puts to calls one stock at a time, going more in depth, and then keeping a scorecard of the results up on my website. Let me know if you have any ideas or would like to see any backtests or features. And that's it. Bye. Now I will magically create a portal into my home.